Good day, investors. Today we are looking at Vopak, a Dutch company. It's a leading independent tank storage company, enabling global energy and chemical flows. They are expanding recently more into LNG, hydrogen, and new energies. They have a strong moat with scale, regulatory and capital barriers, and long-term contracts which lock clients in. They are focused on shareholder value on the long run, steady dividends, manageable leverage, and sustainability. I estimate the value of around 56 euros per share, and we'll see more about their depth and profitability in a bit. So Vopak is the world's leading independent tank storage company. It provides storage and handling services for bulk liquid and gas products, chemicals, oils, food products, LNG, biofuels, you name it. It operates through geographically segmented terminal networks, as you will see on the next slide. Because of the midstream and storage are bottlenecks in many energy and chemical value chains, Vopak plays an enabling infrastructure role. So it doesn't produce the chemicals or fuel, but enables the flow to be stored and delivered on time. I will show more on that later. Via legal entity, Vopak dates back to 1999 through a merger. Its predecessor goes back centuries. I think the 16th century, 1600s. And yes, and currently they are in a growing phase, which is exciting. So you can see that Vopak is well spread out the world. You can see a geographical breakdown in their last report I found. You can see Asia is big, NL is big, China. So it's a diversified energy business, and they are not making any. They are storing them. So you will see a different economics and why that matters a lot. Product diversification. Oil is still the biggest part, but gas is coming up. With the Russia-Ukraine situation in Europe, more gas storage is needed to store LNG with less pipeline gas coming from Russia. Chemicals business, I'll mention some on that. The management, they are trying to focus on higher margin parts, and chemicals can be lower margins, so they try to shift away from those. And then, yes, as mentioned, they have a clear growth strategy, trying to invest gas and industrials going forward, energy transition. You see that a small part is commissioned so far, and the large part is under investment commitment, and some are under already construction. So they are growing, they are here to stay. They are not a dying out business or, hey, energy transition is gonna kill us. No, they are not going away. They have a good moat, and they are growing. And I said before that they are not making any oil or gas themselves. They are midstream. They are enabling infrastructure. What does that mean? That means that they could be a perfect hedge for if you have any oil companies, oil stocks. So and you will see more data on that. So there is a paying to store oil, right? You can see when oil prices collapsed in the COVID lockdowns, you will see on their free cash flow numbers prices soar for storage costs. First, you have these caves, these like low-hanging fruits where you can store oil, but then you pick anything up and the price shuts up. It's like when you have Houthis attacking commercial ships, you will see freight costs go up. It's the same dynamic. So there is a contango, it's called, when the spot price is below the forward price. So if today's spot price is lower than the forward price, traders store oil to profit later, which means higher demand for Vopak storage. And the backwardation is basically when spot price is higher than forward, storing oil is less profitable, and it's lower demand for Vopak. They have a constant demand, and they have this optionality of, hey, I've got more coming in. And this is usually happening with slow global economic activity and an oil glut, which many are saying, if you look at, we are here, that in 26 there could be, so if there is a US recession, oil prices go lower, You have OPEC raising recently 134,000 barrels per day quotas. So if you have more oil than demand, and I would emphasize that it's not a supply issue. So it's not like oversupply, like people like to say. It's more of like an under demand. There is a structural global slowdown due to many causes, mainly government interference and uncertainties given of the government interference, tariffs, trade disputes, geopolitical issues. You have less demand. You have less demand for oil, because oil is a really inelastic thing, and the economy is gonna need it basically no matter the price. But if the economy is suffering, it's not gonna need as much. Oil supply relative to demand is higher. You have a glut. Vopak is profiting. You can see on the shareholder structure, it's mainly held by HAL Trust, which is a Dutch investment holding company with long-term stakes. And then you have Spruce also, which is a global institutional based in Canada, also with long-term values. So this is a really good skin in the game partnership, especially HAL, of course. On their Moat side, Vopak is a global terminal network, gives geographic reach and optionality for customers. So once you commit flows, switching terminal operators is costly. Operating many terminals also gives operational synergies. Building new large-scale liquid and gas storage terminals is capital intensive, so complex regarding safety, regulation, land permitting, and often subject to local constraints. That raises hurdles for new entrants. So clients tend to want reliable long-term storage and relations. They will hesitate to switch operators due to interrupted supply flows, integration costs, regulatory approvals. So terminals in trade hubs, access to shipping, pipeline routes, proximity provides location advantage that's hard to replicate. So storage, safety is paramount. So terminal failure, leaks, everything. You don't want to mess with your with Vopak if you have a long-term partnership. You don't want to risk. So these are sticky assets. Once the terminal is built, it's specialized, can be easily repurposed. So that locks in incumbents. There could be risks over capacity in regional markets. Could reduce pricing leverage. Regulatory environment or political changes can cause issues. Technological energy shifts could hurt them, and competition from integrated players like huge oil majors who might vertically integrate long-term could encroach on them. And of course, terminal life and maintenance, aging infrastructure needs continuous capex, and failure to invest could erode these advantages they have. Their dividend policy is just to maintain or grow annually, so they have a stable outlook, focus on safety, sustainability, and disciplined growth, reducing exposure to low return chemical assets, right? They have an ongoing buyback program, and they want to maintain low leverage and transparent reporting. And on this point, I'm really happy because their incentive structure is really simple to read. You have 40%, this is short term, this is long term. So short term, EBITDA 40% weight, operating capex, right? Injuries, safety. I don't know what net promoter score is, to be honest. Customer satisfaction. Yeah. I'm not sure this is good. I'm not sure this is... Like, these two are not, I wouldn't say that business oriented, but the rest I think is genuinely useful for a company like this. And on the long-term perspective, you want to have operating cash return, very commercial. Capex commitments, very important for them to keep their moats, to expand, to maintain. New synergies, investments, really good. So overall, good. Not so good. Majority is good. I like where they stand. It's a Dutch company. Best you can hope for a European company to have this rational approach and incentives. And if you look at remuneration history, you see that free cash flow in purple, dividends orange, and buybacks yellow. So they have a huge ongoing buyback program from 2024. You see that, and what I really like is look at their share price versus Brent crude. So when Brent crude is going up, like in 2022, you don't have issue with storage, you have issue with lack of oil or lack of supply. Brent shuts up, Vopa is going down. Their cash flow, by the way, it's interesting that it was kind of doing okay in 2022, but basically Brent went up, they went down. And then this happened before. And then now look at this. Brent is been going down since the peak of 2022, and then share price is going up since there. So they are basically hedging against. So you can hedge sort of oil prices with buying Vopak. And if you have a glut, oil price goes up, Vopak free cash flow goes up because they have more incoming demand for the storage. So this is, I think, really good if you have a large oil exposure. Margin of safety perspective. So I always like to use 10% rate of return as a minimum required rate of return. Based on that, they have, if I look at 2018 free cash flow versus 2024, that would be like a 23% compounded annual growth rate. I think I don't want to use by far nothing like that. We know they grow. So I just use 3%. So it's very conservative in my opinion in the long term to grow by 3% for a business like this. With that, you get like 56 euro per share. You can see they also break down growth and sustain capex in their annual report. So transparency is really good. I really like this Dutch culture that you get everything and they are not hiding anything from you. But their capex is kind of high. So it's not a Coca-Cola where you basically spend 5% of your capex relative to your operational cash flow, but they have to maintain, right? So if you look at this, they spend 2/3 on sustaining and 1/3 on expansion. In the past, it was different. This is probably gonna go with their guidance on future growth. So they're moderately profitable. If you look at the return on equity of 24 was outstanding. On the 7-year average is 11%. That's not bad. That's, let's say, an above average, but moderate for sure. Return on investment is so-so. They have still debt, so that helps your return on equity if you use more debt. Regarding debt, they are sitting around 60-ish%, which is okay. European companies tend to have higher, but so that's manageable, of course. They have a cyclical nature to their business, although not as cyclical as oil, as we just saw. Cost of debt is actually lower than their 7-year average, which is interesting because interest rates are higher than the 7-year average. Coverage ratio, I think they are hovering around, and I only used interest payments here. They have leases, so that would bring coverage ratio even lower. This is above 5, I would say it's safe, but maybe you would want this higher. And their current ratio has been always lower, I assume, because of their lock-in and clients, so they have a steady contracts and cash flows, so they don't have to store a lot of cash at hand and current assets. And they have revolver credit. Businesses like this can get away with this, but for example, a gold mining company wouldn't want to be this low on current ratio. They have, of course, risk around regulation. Terminal downtime is huge risk that you have built-in assets and nobody uses them. So, but that's haven't been really the issue in the last 7-8 years. I saw they are hovering around 90% usage, so that's good. And actually, they've been going higher since 2022. So they were like upper 80s and now they are like lower 90s. So that adds to the oil glut theory. Of course, execution on all of their agendas and projects are crucial. And the energy transition. I always like to say it's not a transition. It's an addition. You always add. Coal is at a peak usage. So oil didn't replace coal or gas didn't replace coal. They just added on top because global energy demand keep going up. I will add probably a slide on that on the next energy related company. And look at the stock summary table as a summary. You can see I have Vopak here. With all that discussed, you should have a 42% upside. And that means if you have the stock at $56 per share, then you would have a interior 10% free cash flow yield. So if you would be the sole owner of the business, you could take annually out 10% after paying all your sustain and growth capex and expenses. And that would be it. Let me know if you enjoyed this video and like and subscribe. Take care, guys, and see you in the next one. Cheers.